For lawsuit money, the exam wants you to ask one question first. What is this payment replacing? If it replaces something that would have been taxable business income, it's usually taxable. If it's paying for personal physical injury or physical sickness, it can be excluded. Then you separately classify add-ons like punitive damages and interest, because those have their own rules. The big exclusion is for damages received on account of personal physical injuries or physical sickness. That's the classic car accident type recovery. In a business context, you still apply it the same way. Compensatory damages tied to physical injury can be excluded from income. On the EA exam, they love the trap where the taxpayer is self-employed. Physical injury damages still aren't business income just because you are working. Now the harsh rule. Punitive damages are always taxable, even if the underlying case involved physical injury. Punitive damages are meant to punish, not compensate. Here's the twist they test in business income. Punitive damages are generally not self-employment income, so you may include them in gross income, but they typically don't go on Schedule SE as net earnings from self-employment. Interest is another easy point getter. Interest on any court award is taxable, no matter what the underlying damages were. So even if the compensatory piece for physical injury is excluded, the interest portion is still included in income. On exam questions, look for wording like plus interest or prejudgment interest. That piece is taxable and usually reported as interest income, not business receipts. Most business-related recoveries are taxable because they replace taxable items. Think breach of contract, interference with business operations, patent or copyright infringement, and especially lost profits. If the lawsuit payment is basically the income you would have earned, it's taxable. In many cases, it's treated like business income because it's a substitute for business receipts. Let's tie it together with the classic fact pattern. A self-employed trucker wins compensatory damages for a crushed foot, excluded, even though it happened on a haul. But the jury also awards punitive damages, taxable. And if the award includes interest, that interest is taxable too. Exam tip: don't automatically throw lawsuit money onto Schedule C or Schedule SE. Classify each piece first, then decide where it belongs. Danielle is a sole proprietor of a nail salon with net profit of $25,000. Her husband, Ethan, is also self-employed and has a carpentry business with a net loss of $1,500. They file jointly. How should the income and loss be reported, and what amount is subject to self-employment tax? Think about it. The correct answer is A. Each spouse reports their own sole proprietorship on a separate Schedule C, and self-employment tax is computed separately for each spouse on their own Schedule SE. Ethan's Schedule C loss does not reduce Danielle's net earnings for SE tax purposes, so Danielle's Schedule SE reflects her $25,000 of net earnings. The tempting wrong choice is the one that nets them together to get $23,500. Which statement best describes the income distribution deduction, or IDD, for an estate? One option says it's a beneficiary deduction. Another says the estate deducts income required to be distributed currently and other amounts properly paid, credited, or required to be distributed. Another says it's for admin expenses. Another says it's for all distributed income. Think about it. The correct answer is B. The IDD is a deduction taken by the estate or trust for income required to be distributed currently, plus other amounts properly paid, credited, or required to be distributed to beneficiaries, generally limited by DNI. The tempting wrong answer is all income distributed, but the deduction isn't unlimited. It's tied to distributable net income concepts.